Wow. Nov Jan, negative 70. All right,
Yeah,
Greg.
what a difference a week makes.
Oy vey. That seems like it doesn't want to stop either. 89 contracts traded.
Yeah, no, I think we probably go out to negative 80 for starters, and if Sep Nova's any indication, then it could bleed out to 100, 120, 140.
It certainly plowed the road for it, right?
Yeah, yeah. I think at the very least, when you've got this disconnect between futures and cash, it puts the front month in a interesting position in that at the end of the day, who's going to take delivery of something at a premium to physical cash?
Yeah. The mechanics of it don't seem to be working as planned right now, right?
No, no. I think, and I'm sorry, I'm just going to give you a basis update here. Assuming that so from when we spoke a week ago, Mike, the basis was somewhere in a range of 150 to 190. Futures were in that 730 to 790 area a week ago, vacillating all around. Cash was $580 with print last Tuesday night. So it puts you in that 150 to 190 area. As of this morning, with the collapse in futures here, and we're off limit. We were limit at one point this morning, limit down. Print realistically is probably going to be conservatively a 610 to 620, 625, depending on what mill he looks at, random looks at. So, your convergence is gone from 150 to 190 into $90 in less than a week. And the expectation is that as you grind through October, I don't know if you need perfect convergence here, but by the end of October, I would think we'll be somewhere in a minimum that 50 to 70 over cash. So convergence does work. Basis convergence does work. You just, again, it's speculating on, I think cash is going to go up, future is going to go down. You're just looking for that convergence to take place.
Yes, we covered convergence last week. So let's get this thing kicked off, which you kind of already did. Welcome, everyone. This is Lumber Futures Chat with Greg Kuta, Westline Capital. Hello, Greg. Mike
Hello, hello.
Wasniewski here, CEO of Materials Exchange, the digital marketplace to buy and sell lumber. We're talking about lumber futures because we want you, the listener, to be a more informed person in your day-to-day operations in the lumber market. So with that, we're kicking this thing off with just talking about where the lumber futures is at right now. So Greg Kuta, last trade in lumber futures is?
We're 708.10 last, down 490, 4090. We just traded limit down. So we're officially limit down again, and there is a pool of 6 right now.
Okay. So you know what? What the heck? Limit down. What does that mean? What does limit down mean?
Limit is basically the exchange designates a trading range on any given day. For lumber, it's $42. So a market cannot trade more than $42 higher or $42 lower on any given day. When it hits that limit, the market can't go lower for that day. It basically stops at that level. The next day, the limit gets expanded.
So basically, right now, no one is willing to pay 707 or greater.
Yeah, as of right now, no. The next bid underneath, obviously, which we can't trade to today, is a 705, and then you drop down to 699.10, 675, so on and so forth.
Got it. Got it. Now, you're speaking only a half truth, Greg. That's the limit today. Something that's very important to know is these limits are going to change on November 1st.
Yeah.
And on November 1st, the limits will be, well, there's a formula.
So the numbers were finalized as of the 15th of October last Friday. They're going to be around $30, either $30 or $31, depending on how the CME wants to round. So you'll have a new daily limit of $30 to $31. You'll have an expanded limit somewhere around $45.
And that limit, those limits or those numbers will be good through April 1st,
Yeah,
correct?
you'll take effect as of November 1st through April 1st.
And the next adjustment period is the next adjustment date is April 1st. So we'll
Yeah.
put that in the back of everyone's mind. So today, what is what let's go back to the market. We're limit down in November, but what stands out to me is that spread, the November to January, the price difference between where November is trading and January is trading. We call it the spread, the Novjan spread. It's out to negative. Last trade was negative $69.50.
Yeah, Mike, and you can see a visual representation on the slide deck I sent you. Slide number 4 gives you a Novjan daily spread differential here.
Nick, can you pull that up if you get a chance? So it's going to be that's the Nov daily. The next one. There
There
we
you go,
go.
right there.
All right. So, wow, different charts. This Novjan spread looking down. Nick, will you roll to the chart just before that? And here's the Nov daily.
Yeah. So
Trending up.
when you look at the Nov daily, a week ago, this spread was somewhere in the negative 25 to negative 35 area, meaning November was trading at a discount to January of about 25 to $35. So in 1 week's time period, the spread's gone from a negative 25 out to as wide as negative 750 today. So at the very least, the way you're long a market. Hey, I don't trade spreads. I don't care about the spreads. Well, like this is why it's so relevant and important to understand the spreads. And that if I'm long November a week ago versus being net long January a week ago, I would have left, that move from negative 2050 to negative 750, let's call it $40, $45 in buying, but just by being long a November contract or being net long a January contract. With this spread widening out, if you were long November, you left $40 to $45 a thousand on the table versus being long January. The
Yeah.
November has lost $40 to $45 relative to January. That's a
Yeah.
fact. That's not opinion.
Right. Both markets are strong, moving higher. Overall strong, moving higher. The trend is, but January was stronger, moved up a little faster.
Yeah. And I think, that's evident with, and I know we're going to segue into, the idea of what open interest is. But when you look at open interests over this same time period, we've seen a build of around 250 to 300 contracts. But when you go back and look at the actual build of open interest, November is a losing contract, meaning open interest is declining, versus January and March actually gaining. So the pickup in the open interest, the net growth in open interest is in January, is in March, where I think at the very least, you could make the case that commercially people might not be able to buy physical cash today and pay the cost to carry. So we don't want to get caught like we did last spring and not having ownership on spring type jobs. So let's buy January, let's buy March, regardless of the premium, regardless of the basis, the differential between cash. There seems to be comfort in owning January and March. And that's evident by, January and March kind of outpacing November to the upside here.
Perfect segue. Let's talk open interest. And for everyone listening, once again, I will interpret the verbiage that rolls off Greg's tongue like the expert that he is in having been in the futures industry for the last 20 some years. Open interest. So I think it's important to define exactly what a futures contract is. It is nothing more than a legal agreement between a buyer and a seller. It can be created and it can be destroyed. It can be created by two people matching on a buy and a sell, that they are entering into a new contract. It's destroyed when that person who is either long owns the contract, short has sold the contract, decides to cover their position, or when they're long owning the contract, they sell their contract. They no longer have a position, or they would look on their statement at the end of the day, and it would say zero. I owned a contract yesterday. Today I don't. That contract was destroyed. So open interest is a moving, living, breathing. I don't know, living, breathing, but it's a moving target. Do you have what could you add to that, Greg?
Yeah, no, I think at its most simplest comprehension of what open interest is, it's just the number of outstanding contracts. And it doesn't matter if you're looking at lumber, you could be looking at something like gold, you could be looking at mini S&P futures, you could be looking at 30-year treasury bonds, you could be looking at 10-year notes, you could be looking at Bitcoin. It's just the number of outstanding contracts in the market. And for every buyer, there's a seller, but at the end of the day, the CME has reconciliation of outstanding positions on everybody's books. So the clearing houses that you trade through basically have a running total of outstanding contracts in every single market that's traded. So they're basically collecting that data. They're aggregately turning it into the CME, and the CME is just, again, keeping that running total of the outstanding contracts out there. And for every buyer there's a seller. So when you look at somebody's financial statement, if I'm long a futures contract and I liquidate that futures contract, that's a decrease of one contract with open interest. If I'm long and I buy a second contract, then that's an increase of one contract. So that's a net one increase. So if you have somebody net buying one and net selling one, then that would be a two contract increase. So the CME, it's just simple mathematics. It's very basic arithmetic and subtraction. They're just looking at the aggregate total of outstanding contracts out there.
Perfect. So, Nick, can you roll to the slide that shows the daily bulletin? And this is one more. There we go. Okay, so this is a report that you can get from the CME website, and they call it the daily bulletin. It is just a report of what activity was on the platform the day before. What we're talking about today is the open interest column, which is kind of middle of the page over to the right, just to the right of where the prices are. And the CME group will tell you this is how many outstanding contracts we have on every day. Now, historically, the number of the size of our open interest right now is extremely low. It's record low, basically, right?
Yeah, and Mike, if you want to, just so people can get a comprehension of where open interest stands, if you go to slide number 8, there's a comparison of this year's total open interest versus the last 6 years.
No, one more. There. So this year is the orange line. You can see 2021, and it's declining. So
yeah, no, it's declining. A couple of obvious thoughts here, and that seasonally, this is typically when open interest bottoms out into the September, October time period. And then as people turn the page into trying to figure out what their spring needs for the upcoming year will be, you start to gradually build open interest again. Obviously, we're at historically low open interest. Some of the thoughts on that is that the obvious volatility we've just spun out of has been physically, mentally exhausting, and you've exhausted traders out of the market. We're good, bad, and different. When you have the kind of volatility we've just spun out of, you exhaust people to the sidelines, both long and shorts. When a market goes straight up and then comes straight down, you unfortunately push people to the sidelines. And then as you reset and you begin to trade in some more normalized trading ranges, then you gradually start to grow open interest again. And that's kind of, I look at this time period right now as we're reseeding open interest here for next spring, next year.
Right. And now, what you're saying about volatility is very true. And we're going to talk about volatility in the next one of these upcoming shows. But as volatility went up, the margin that the CME requires you to have on also increased. We talked about that last week. So if you are a speculator in this market and you have a finite sum of money that you are putting at risk, the amount of contracts that you can actually trade with that finite sum of money has decreased because the margin requirement has gone up. So, margin requirement is $5,000, say, and you have $50,000 that you can put at risk. Today, you could trade 10 contracts. 2 years ago, the margin was probably $1,250. So with $5,000, you could have traded 40 contracts. So it's not surprising to me that the open interest is lower, just because of that. I think it's important to look at the market through the eyes of not just the industry, but through the speculator as well. And why don't we segue?
Mike, just one quick follow up to that. I'll kind of give you the CME's perspective as well. They have something called span margining, and span margining looks at underlying notional contract value, but then also a huge major component of how the CME determines margins is the volatility. And when you have lumber as the poster child of a volatile market, the volatility reigns supreme as far as how they do margin calculations. So the CME on the move from 500 up to 700 up to 1,000 up to 1,700 had no problem resetting margins higher and higher to where you probably had, I want to say, 4 or 5 increases in margin requirements since the market topped out in May. From 1,700, we've reset sub 500 here. We've only had one margin decrease since then. We've had no margin decreases in the spreads. So volatility is still, even though the notional value of the underlying contract is significantly less, the volatility component of lumber, still a highly volatile commodity, weighs heavily on how the CME calculates margins. So I do think, to give people kind of hope here, as the price limits reset into November 1st, you're likely to see margins come down in both the outright futures and spread margins after November 1st. Or so like that. They're not going to say that for certain, but that's something, in speaking to head of margins at the CME, that weighs heavily into how they're looking at this right now.
Sure. All right. So we've defined open interest. Fantastic. We've looked at where you can see open interest on a daily, day-to-day basis through the CME. Let's talk about another really interesting report, and that is the Commitment of Traders report, which is actually produced by the CFTC, the Commodity Futures Trading Commission. So, Nick, if you can roll to the next slide.
And Nick, that would be slide 6 and 7. I just gave 2 examples of there's variations on this report, but
let's look at this one first, because I think
okay.
we look at this and then we can roll into the next one. Just gets a little more granular. All right, so the CFTC actually reports on what segments of the industry or what type of traders are involved in the futures market. Now, there's people out there that are going to do some math here and say, well, wait a minute, these numbers don't all add up to what the total open interest is. And that's because there's a size of trader or size of position that is reportable, and then there's smaller positions that are non-reportable. These are the larger positions that are reportable. And they break this into non-commercial, commercial, non-commercial and commercial for this one. So, Greg, what's a non-commercial? What's a commercial?
A non-commercial, the easiest way to explain a commercial is so the CFTC has something called the CFTC Form 40, which basically tries to designate traders. So anybody that trades a position larger than 25 contracts is considered a reportable position. So if you own collectively 25 cars of lumber futures, 25 cars of options, or a combination of, for X amount of period of time, the CFTC, Commodity Futures Trading Commission, is going to come to you and say, hey, please fill out this form. And all they're trying to figure out is what exactly are you doing for a living? Are you a large speculator, or do you have a vested interest? Are you considered a bona fide hedger, where you're a sawmill or a private equity that's using futures to hedge future jobs? They're just trying to get a clarification to segment you out as either a commercial that has a vested interest or a non-commercial that is considered a speculator. And so it's that simple. And so in filling out these forms and helping people fill out these forms, the CME just wants to segment you, silo you off into, are you a speculator or a hedger? And that's the difference, main difference between a non-commercial versus a commercial. I will say that depending on how you fill out these forms, that's not always 100% accurate, in that there are commercials that technically would be considered commercials, but they speculate. There are speculators that could be considered commercials, but it's just in how they want to fill this out. It's accurate to a point. Let's put it that way.
It's very accurate gray area, is what you're saying.
Yeah, exactly. And so, once you get classified as a large trader, 25 contracts or greater, you're always going to be considered in that group. So even if you're a large trader and you trade 25 contracts, the margins go up, you only trade 2 contracts, 5 contracts. As far as the CME is concerned, once a large trader, always a large trader.
Yeah,
So you stay in that pool.
I became a large trader in 2010. Soon after I started trading, it didn't take long. Okay, let's roll to the next slide, Nick. Now this is a more granular look, and so the first thing I want to say, looking at this data one time is going to be kind of fascinating, interesting, but it doesn't give you much value. You need to look at this data consistently every week in and week out and see the trends. It's the trends is where the real information comes from. So now we've broken this out a little bit more, and what you can see is the first 2 columns there. Well, I said second and third column, producer merchant. It says long and short positions for them. So the one thing we can basically assume is that a sawmill is always long lumber. Just by the nature of their business, they make it every day. They need to continually try to sell it. So what you're going to see in these columns is that the short interest in the producer merchant is generally higher. I don't know that I've ever seen it flipped. Have you?
No, I think, so part of this will help. Are you in a bear market, bull market structure? There's a lot that goes into this, but at the end of the day, sawmills, and I know Ashley asked this question: are sawmills do sawmills ever go long? And the semi-funny answer is no comment. Yeah, sawmills can go long. So you do have sawmills that have that trade their own pension accounts, and they'll speculate on lumber, where it's siloed off from the risk management aspect of what they do, and they can go long, they can go short. Lumber, just like any other investment. So the indirect answer is, yeah, sawmills. And again, unless it's completely written, look, they all have board of resolutions. Are they publicly traded, privately traded? Obviously, if you're a publicly traded sawmill, it gets a little bit more nefarious. But privately held companies can do whatever they want. As long as it's in their board resolution, they can do what they want.
Sure. But for the most part, the short interest in here is going to be sawmills, and then basis traders, people who have hedging on-ground inventory. The longs in this section, the people that have bought it, are generally people that are doing forward pricing or are protecting business that they have on the books.
Sure. And Mike, I think that's a great, okay, wait a second. You just told me that we have this historically wide basis. How could anybody in their right mind be buying futures when cash is at this substantial discount? The easy answer is that not everybody can buy physical cash. They don't have the storage capacity. They don't have the ability to pay the cost to carry and hold the wood until their spring needs develop. But they want to get coverage on jobs that they've quoted. They want to lock it in. Hey, we know we can quote this business in January or March at this price. This is an acceptable profit margin. We'll live with the consequences. We know we're paying up from a premium standpoint, but that's who would be buying January. That's who would be buying March and beyond right now from a commercial standpoint. People that need coverage on jobs that they've quoted, and they don't want to speculate on waiting to buy that physical cash when the jobs come due.
Absolutely. So you take a office wholesaler who does a forward pricing contract. Now, if they tie that money up by buying the cash for 6 months, that money is no longer available for them to spin or to roll. I think when we were back in the wholesale business, we wanted to turn our money a minimum of 6 times a year, and really trying to get it closer to that 10 times per year. So if you make 4% margin 10 times a year, that's a 40% margin on your investable money over the course of 12 months. There's no way that you're going to be able to get a 40% margin in a forward pricing contract and tie your money up for a year. So
Yep.
it just makes more sense. Pay up, but have dry gunpowder to continue operating your business on a day in and day out basis.
Yeah. Yep.
So that's why they're buying. Let's move to the right a little bit on this. And now we've got swap dealers and managed money. Managed money is pretty simple. I mean, those are just commodity funds that are, speculating in the market. They think lumber is going higher. They buy it. And in this case, you look and the managed money is generally long here.
Yeah, and I will say with managed money in general, they don't necessarily tend to be contrarian, meaning they don't tend to fade markets as much as the vast majority of time they're trying to capitalize on market momentum. So if commodities, there's going to be a super cycle, a bull market in commodities. We want to diversify our portfolio, our exposure. So we're just going to buy a basket of goods. We want exposure to fiber. We want exposure to something like lumber. We're going to buy lumber. It's a 1%, 2% allocation of our total portfolio. Typically, the managed money follows the momentum. The managed money rarely tries to pick tops and bottoms unless they're exiting. Typically, managed money comes in to chase the momentum, either up or down.
And the swap dealers, that sounds like a pretty strange name to be a swap
So,
dealer.
again, I know, yeah, there's somebody on this call that knows a thing about swaps or two, but swap dealers would be somebody like Koch Industries. I know FC Stone does swaps. So swaps are basically where you have a counterparty on each side, and it's a known counterparty, and there's an agreed upon price over a certain duration of time, and at the end of that contract, it's just financially settled. There's no physical exchange of lumber. This is the price we started at. This is the price we finished at. There's a financial transaction. You can either re-up the swap or the swap, ends. So basically, when you look at swap dealers, so if I go out and quote this swap and I've got this financial exposure, I want to lock it in. So the swap dealers will come in and lock in their risk or speculate in futures to capture more profit margin. It just depends on, what they're looking to do.
So then the last column is other reportables. That's just kind of everyone who doesn't fit in those first three definitions. So let's real quick, moving left to right. You've got lumber mills. You've got sophisticated financial operations. You've got speculative fund type business. And then in the last column is generally it's individual type of investor or individual traders would be in that.
Yeah, exactly.
So I think this report is fascinating. I look at it every week when it comes out. It comes out on a Friday afternoon. It says what the positions were as of the previous Tuesday. so three days earlier. I sit here and when I look at it, I just look for changes and see kind of what's going on. And generally, what I see changing in there makes sense as to what just happened in the lumber market.
Yeah, and the one thing I'll add to that, Mike, is that, I always look at it as that producer component. They have a vested interest in what they're doing. So over the long run, they tend to have a tendency to be more right than wrong because they have the ability to withstand the market moves in understanding that, if I'm a large producer, it's a sad day when I'm collecting on my short position because, as Ash referenced in the commentary, when you referenced, lumber producers are always long. Every day they're producing lumber, so they're always net long. So when they capture their short position in futures, is that a good thing or bad thing? The reality is margin calls are good for a producer within reason. So I always, when I look at that commercial position, those typically have the best staying power because they have a vested interest in what they're doing. When I look at the managed money component, they come in like a bull in a china shop. When they stop, there better be good underlying fundamentals to justify the amplification of whatever they do in the marketplace. There better be good underlying fundamentals to support their move because you need the commercial component of it to back it up. If that's not the case, then you create these giant voids above or below the market that ultimately the market corrects back to where the fundamentals suggest the market should be.
So we're at the 30-minute mark. Here's what I'd like to do. Let's just throw out a couple of strategies on how to take watching open interest. And I guess these are kind of common beliefs. So as open interest is rising, that shows interest in this market. It shows people wanting to get into the market. It's generally a precursor or kind of in the middle, my experience. It's a precursor or in the middle of a significant market move. Would you agree?
Yeah, I agree. Yep.
Now, as you see open interest declining, it tends to happen at the end of a move. It's when the market has gone somewhere. The people who are right are exiting their position. The people that were wrong have kind of thrown in the towel and you've exhausted their staying power. So you tend to see at the end of a market move, you'll see declining open interest.
Yeah, and just one thing further I'll add to the existing market, Mike, is that for this to be a sustainable move higher, whether you're talking about cash or futures, if we're going to be in a sustainable uptrend, then at the very least, you want to continue to see a build in lumber options, futures and options open interest. That shows that the fundamentals, people believe in that rally, and you build the open interest to support it. If you're not going to build open interest, then at some point it becomes more questionable on the sustainability of that move.
Yep. And the last caveat I would say is you cannot hang your hat on one data point.
Sure.
I would say 50% of the time, open interest just tells you how many people are in the market and out of the market. It's what I look for is when we're getting to a point in the market that I think is a ending point or starting point, I start to really monitor open interest and say, is that confirming my belief? Is that just adding one more data point that will reinforce the belief that I have on how I see the market going forward?
Yeah, I think that's a great point, Mike. I agree.
All right. So this wraps up. This is our third week of doing lumber futures. Our goal here is to do some education and then roll into a little bit of commentary on where the market's at. Next week, I believe we're going to take a look at volatility, which is a big topic. We'll probably split that into a couple different segments. But if there's anything that you ever want to know about the market, of course, you can always reach out to Greg, reach out to myself. And if there's something you would like us to cover on future calls, reach out to us and we will do that. With that, I'm going to say good luck, safe trading, safe life, and we'll talk to you guys in a week.
Thanks again, Mike. I appreciate it.
All right, take care.